I think it's just a peculiar thing going on with London because the ETFs happen to be stored, their metals happens to be mostly stored in London. I think SLV has a little bit in New York, but the amount of silver in being stored for SLV New York hasn't changed in many years. It's the same in the same JPM vault. What changes is the vaults in London. So it's just signaling that London, which is the main physical spot market for the world, is short on silver. Not they're selling it short. I was saying they don't have enough supply, and you can see that in the float because they have to store for the ETFs. And though ETF storage is not anywhere near where it was in 2011, it's slowly building back to that as investment demand is growing. Silver squeeze was an interesting movement back in February 2021. Now is when it could really succeed, because if people bought a bunch of silver ETFs, then they could really blow that spread out.
In today's news recap, gold turns lower despite U.S. inflation data, set to end 9-week win streak. Gold prices paired losses on Friday after slightly softer than expected U.S. inflation data reinforced expectations that the Federal Reserve will cut interest rates next week, but the metal was still set for its first weekly loss in 10 weeks. Spot gold was last down 0.57% at $4,101.61 per ounce after falling nearly 2% earlier in the session. The price is down more than 3% for the week. Gold and silver jump as September core CPI comes in lower than expectations, but it's likely insufficient to entirely blunt this week's sell-off. Price action suggests that gold and especially silver need another leg lower before consolidation, said Tai Wong, an independent metals trader. Spot gold notched a record high of $4,381.21 on Monday, but has fallen over 6% since, as investors booked profits and signs of easing U.S.-China trade tensions dented safe haven demand. Labor Department data showed that U.S. consumer prices rose 3.0% in the 12 months through September, slightly below economists' expectations of a 3.1% increase. Traders are almost fully pricing in a rate cut at the U.S. central bank's meeting next week, with another expected in December. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold. Meanwhile, the White House confirmed on Thursday that U.S. President Donald Trump will meet Chinese President Xi Jinping next week ahead of the November 1st deadline for additional U.S. tariffs on Chinese imports. If gold prices fall below $4,000, we're going to continue to see more of a dramatic washout in the market, perhaps down to $3,850, the next major support level, said Philip Streibel, chief market strategist at Blue Line Futures. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
To realize that we are not yet in the final sprint to the end game because the next printing round hasn't even started yet. Right? The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. Nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started, it kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to. Whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then you have, it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did. And it reached a low of 1450, and the miners got clobbered, I don't know, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. But that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric, and we can't be too discouraged, because we're still in a dollar short squeeze where there's more debt than dollars that exist.
In today's news recap, JP Morgan sees gold shining at $5,000 by 2026. JP Morgan analysts on Thursday maintained a bullish outlook on gold, forecasting prices could reach an average of $5,055 per ounce by the fourth quarter of 2026. The forecast is based on demand assumptions that see investor demand and central bank buying averaging around 566 tons a quarter in 2026. The bank said in a note. Gold remains our highest conviction long for the year, and we see further upside as the market enters a Fed rate cutting cycle, Natasha Kaneva, head of global commodities strategy at JP Morgan, said. The combination of a Fed cutting cycle with overlays of stagflation anxiety, concerns around Fed independence, and broader debasement hedging supports gold's upside, Gregory Shearer, head of base and precious metals strategy, said. So let me get this straight. Is JP Morgan going to nail this one, or are they just talking their book? Is this a classic sell the news? What do you think, you guys? On the dollar, the bank noted that the rally is not a de-dollarization or not a debasement story, but it is most likely a dollar diversification story, highlighting that foreign holders of U.S. assets are gradually redirecting small allocations into gold. JP Morgan analysts also highlighted that recent market consolidation is healthy. The pullback reflects the market digesting the rapid price gains since August, said Kaneva. It's normal if you're paralyzed with fear because the price moved so fast. It's just a very clean story. You have a lot of buyers and you have no sellers, she said. She reiterated a long-term target of $6,000 per ounce by 2028, stressing that gold should be viewed on a multi-year horizon.
But before we go into the reasons why, we just have to remember that this is what has happened every time since 1918. Since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then the silver dollar was worth more than the gold dollar. It was 1918 was the first time this century. You had it in 1968, 1980, 2011. Every single time there's some sort of a monetary reset, minor or major, then silver always handily outperforms gold. Like obviously, what's that word? Not sporadically. Like in a frenzy. There's just a huge bid for silver, and we didn't see anything near that at all. Like we were applauding, and we were like, giving a nice little polite round of applause to silver when it finally caught up to the rate that gold was rising. And even that wasn't every day. And so maybe since, maybe since August or September, silver has very slightly outperformed gold. But so it went from a ratio of like 107 to 1 in April to now 80 to 1 a few days ago. So, okay, fine. It's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918. If you want to go into the why, it depends where your vision is most keen, what aspects of the gold and silver market you connect to or you look at, are you able to analyze the best. And I'm always broadly monetary. So whenever silver outperforms gold, it's a signal that credit is breaking down. And either the Fed intervenes and it saves the credit market by adding more credit. Adding more credit means adding more debt, because it's the same thing. Credit and debt are two sides of the same coin. So if the Fed's able to add more credit, add more debt, and then it's like a borrower who you're demanding he pay you back, and he gets more credit from someone else, and he's able to pay you back in credit, and you're like, okay, fine. So, I'll extend the term on your loan, and you'll keep giving me this credit. So that's what the Fed does. It just keeps extending the loan. So as long as it can do that, it can calm down the money markets and expand the credit markets. But when silver outperforms gold, that means either the Fed has to reinflate and suppress the monetary prices in terms of credit, or it's done. And this time they'll try to reinflate and it won't work. It'll be done. And we're just waiting for that last surge of silver over gold. It's going to end somewhere around 15 to 1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to zero, starts QE again, and then the metals just go up, limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down.
What do you think of Rafi's take? Do you agree with him? Is this gold and silver correction just a healthy opportunity to buy more, or is the bull run at risk? Post in the comments section your honest opinion and share with the stackers your plan. Now smash the subscribe button and check this video right here because you'll love it, and I'll see you on the other side.